Hey guys, you're listening to the Tasha Labs podcast, and today I want to talk about three things. I want to talk about some of the macro update because the Q2 GDP number, nowcasting number for the US just came out. And secondly, I want to talk about investment framework, specifically related to the debate of hodling versus trading. This is relevant for crypto, but also for investment in general, and my thinking about this has shifted over time and want to share with you some of my thoughts. And thirdly, recently I published this article called Truth versus Bullshit in Crypto, and I got some interesting questions, and so we will cover some of that at the end. Okay. So first of all, macro. So the Atlanta Fed just published this nowcasting Q2 GDP forecast. Not a forecast, but using short-term indicators to estimate GDP. Of course, the number will be different from the final GDP number, but right now it's showing minus 2% year-on-year growth for Q2. So Q1 we had a negative print for GDP number, and Q2 looks like it's still negative. So a lot of people are saying we are already in the recession territory, and the Fed is going to pivot soon, or they should. Well, my thought on this is not so fast, okay? Because if we actually look at what's causing that 2% drop in GDP number. So you can see most of the drop is actually caused by negative investment growth, specifically related to residential investment and also business real estate investment. And what is actually, U.S. of course is a economy that's hugely driven by consumer demand, right? It's a consumption-driven economy. So if you look at the consumption, the Q2 growth is still positive. Well, it's actually pretty flat, but it's slightly positive. So you can argue how accurate this number is, right? But it is it is not a negative number, and this is on real terms. Okay, so it's already removing the price effect. So that brings the question of is this going to cause the Fed to change direction? I don't think so, because now a few months ago, I think I mentioned maybe in the previous episode that San Francisco Fed had this study that they concluded 1/3 of the inflation over the past year in the US is demand driven and 2/3 are supply driven. So the supply driven part is similar to the rest of the world, right? But the demand driven part is kind of unique to the US because we gave out too much subsidies to, over the COVID period, airdropped too much money. So the thing is, the consumer demand is the part that is most relevant for the demand-driven part of CPI, right? So we're still seeing, service prices going up, and this part of it, unless we crush the consumption part of the GDP growth, you are not going to likely have a huge demand destruction effect, and that's called, which is going to cause the demand side of inflation to drop. So I don't think we're there yet. So you may argue, all right, consumer consumption growth, yes, it's still positive, but it's already weakened a whole lot. So maybe in the next couple quarters, we will start to see negative consumption growth. That's quite likely, but we are not there yet. We are still a distance away, right? And you think about, since given the inflation print in recent months has been so high, like I said in the previous episode, we are going to have most likely a policy overshoot. So even if you see, consumption starts to go into a negative territory and inflation print starts to go down, that does not equate the policy direction change in terms of a complete pivot. So a complete capitulation, in my definition, is going from tightening to loosening, right? So I don't think we're going to see that happening, but maybe, so previous forecast for the July FOMC is over 90% probability of another 75 basis point hike, right? So if, let's say, the GDP number affected the Fed's consideration about the pace of tightening, they don't have to hike 75, they can hike 50, or they can, pause in September. That is likely possible to happen, but that is still a change in pace and speed of tightening. That does not mean pivoting. Okay. And not to mention on the other side, which is the quantitative tightening schedule, which is arguably more important to the behavior risk asset. So we know that QT just started, right? And the Fed balance sheet has shrunk from the April peak by about $50 billion. Okay. How much did we pump over the COVID period since 2020? We pumped about $5 trillion. That's the size of expansion of Fed balance sheet. It basically doubled. Okay. So right now, we currently have shrunk about 1% of that extra, Fed balance sheet increase. So if Fed is anywhere serious about QT, this has a long way to go. Now, you may argue they cannot be all that serious about QT, because if you really reduce all that $5 trillion entirely out of the balance sheet, that's going to cause huge issues to not just the risk assets, to the real estate market, to consumer confidence and GDP number. That everything is going to be crushed. So it's not likely that we see things go that far, but I just want to emphasize you see 1% shrinkage of Fed balance sheet, 1% of the increase that we've seen over the COVID period, and that is already caused us so much damage in the market, right? So the number doesn't need to be going down so far. You still can see huge impact to the risk assets. So the bottom line is I do not see any pivot happening. I think we are still in the trenches of it, and my baseline is market is going to drop further, and how much, to what extent, that is a different question. Okay. And not to mention we are in a fragile position in risk assets. So we all the forecast right now is not based on not counting in any kind of exogenous shock that may happen in the second half of the year. So the first half of the year we had Ukraine, and very few people saw that coming, right? So if we have any kind of exogenous shock to the downside, that's not going to look pretty, and nobody is taking that into account right now. But anyway, so that is the macro situation. I'm sorry, there's not much good news to convey. Oh, maybe there are a couple of good news now I think about it. First of all, we see that logistic price index in terms of shipping cost globally has been coming down actually over the past few months. So this may translate into lower inflation print going forward globally. Okay. On the supply side. So that's one piece of positive news that may happen. And secondly, you see China has been opening up. I have a friend who's going to visit family in China right now, and he told me he only has to quarantine for 3 days. Only 3 days instead of 2-3 weeks. That was the previous norm. Okay. And we see the leading indicators, economic activity indicators from China coming out higher than expected recently. So the economy is opening up, and if that part of the global economy comes back online, and that will have a positive impact on logistics, and that will reduce some of the supply bottlenecks, and that's good for reducing inflation worldwide. But it's still a wait and see, still early situation. If there is another COVID wave in China because of the reopening, we may well see another round of shutdown. I don't know, right? So but that is still an ongoing development, but we see some positive things happening. So that is that. And the second thing I want to talk about, as I mentioned, is investment framework. So there are these two popular schools of thoughts I think quite prominently in crypto is related to whether you should hodl or whether you should try to trade and try to buy bottom and sell top, right? So I want to talk about this because I think some of this mentality is especially related to the hodling argument. That is of questionable of questionable validity. Okay, so but if you're a hodler, you're a long-term investor, I totally understand where you're coming from, but I just want to present two sides of the argument because this is not black and white. Okay, you can there are merits on both sides, and ultimately it's a judgment call on your side, but I think it would be useful if we all do more self-reflection and kind of be honest about the motivations, the psychology behind our own behaviors. I think if you just strive to be more self-aware and try to have more self-knowledge through the trades and investment decisions that you do, whether you win or lose, that is going to make you a better investor over the long term, right? And also a better human being if you gain more self-knowledge through some of the decisions you make. So what are the for and against arguments for hodling? So first of all, the for arguments. The advocates for hodling in crypto is very straightforward. You see it, asset class, in the past 15 years has had a tremendous uptrend, right? So the overall trend is going up instead of going down, and going up a lot. So in this market, if you do not hold on, you may miss a lot of up move. If you try to catch bottom and sell top, very few people can do that well, right? So you may miss a lot of the movement, upward movement in the market. And if statistically speaking, the market is going up more than it goes down, and you try to trade, then those decisions, statistically speaking, is going to go against you. Given conditional on the market trend being overall, uptrend over the longer period of time. So hard to time the market, and also if you overtrade, you're going to miss a lot of segments of market rising. And also empirically speaking, you hear all these stories of people making huge gains if they bought the Bitcoin in 2013, they bought Ethereum in 2014, and they just held through all this 80-90% of drawdowns, and they didn't move, and didn't budge, and they kept their conviction, and eventually they got rewarded. So that is the argument for hodling, right? And one more piece of thing is, it's just easier if you're not like a full-time trader / investor. If you don't have the time or energy or the willingness to follow the market, then this gives you something that looks like a certainty to hold on to. If you just cancel out the noises and don't listen to people, and just keep marching on with your hodling. In the long term, the argument is market goes up and you will come out better than people who try to trade. So that is the positive, the pro argument of hodling. I hope I have given it justice. Okay, so here's the other side. Again, some of you may not, depending on which camp you're in, okay, you may not, some of the things that I lay out here may not be music to your ears, but if any of this trigger any defensive or emotional reaction on your part, if any of what I said made you frustrated or angry, then you've got to think about why, right? Because that is a sign that there may be a psychological trigger there that you may want to look into. But anyway, on the other hand, what are the arguments against hodling? Because a lot of times, just because of human psychology is wired this way, that we just don't want to lose, and we don't want to accept that we are wrong in any area of life, right? So this is one manifestation of that, is that when you buy something and the price drops below your purchase price, most of us, we have a tendency to turn into unwilling long-term investors because then we think, oh, I'm just gonna hodl. I'm just because the thing in the long term is gonna go up, okay? Because all the crypto market is going up in the long term. So, or you may think because you have a position in something, you start to have a not so neutral view about the thing that you're holding. Again, because we have this psychology that we don't want to accept that we are ever wrong, right? So if you buy into a token, you tend to have a favorable opinion of it. Well, of course, you already have a favorable opinion since you bought into it, right? But after you bought into it, it's like you already casted your vote, right? Now the mindset is kind of fixed in that position. Now you're like, okay, this thing is golden. This becomes a sort of a baby of yours, right? So you see this happen again and again in the market, and a lot of times people are accused of defending their own backs. They say some positive thing. People accuse that of me, right? If I say some positive thing about a project, it's like, oh, that must be your bag. You're just pumping your bag. Well, the reality is a whole lot more complicated than that, right? First of all, if you buy something, you of course have a positive opinion about it. And secondly, after you buy into it, it's like, the mind, we tend to do this mind trick with ourselves, and we tend to hold on to a favorable opinion, even if it's not like completely objective, right? And that becomes a dangerous thing. So unless you're completely neutral, until the point that you do not take a position, if you're in a position, whether it's long or short, your opinion tend to be biased one way or another, right? Just because we want to, defend our own position and we don't want to be wrong. So, but that just prevents you to be objective about things. And also, a lot of times the hodling really for most people is a excuse for not having any kind of risk management, right? So if you are investor in any assets, and people will tell you risk management is really, really important, right? But if you're hodling, that is like you have no risk management altogether, right? So those are the argument against. And also, last piece of argument against hodling, which to me that's actually the most important thing, okay, which is the following. So investing is a repeated game, all right? It's not like a one-time bet. It's not like you make a bet with your friend about a one-time event and it happened and you won or you lost. That's the one-time thing. Investing is not like that, right? So you have to make repeated decisions. Even if you make a gain from something, from an investment, you most likely, if you get out of the investment, you're going to put your money in something else. That's another decision to make, right? So these are repeated decisions. So statistically speaking, if you have a good framework of making these decisions, that will allow you to make more right decisions than wrong decisions. Or if you have a risk management framework that is going to allow you to take less loss compared to more loss over the long term, then after an extended period of time, you are more likely to come out on top compared to otherwise, right? So if you're saying, but if you're just hodling a position, you do not really have, that does not really allow you to practice any investment skill. You're not practicing taking losses, which is super important part of risk management, right? And you're not practicing taking profits. So and none of these are easy to do if you are any trader will tell you these are actually it definitely takes practice, because your mind will always work against you when you try to take profit or take losses. There are all these things, all these games that we play with ourselves to try to talk ourselves out of making a judicious decision, right? So these are all things that takes practice, and over time, build a investment framework that makes sense for yourself. But if you're just hodling, you're not practicing any of that. So over the long term, even if you make money from a particular trade, you hodled over the long term, you succeeded, kind of made a lot of gains. That's just one. Still, over a long-term span of things, this is just one trade. You're gonna make other decisions, and we all learn from our history, right? So if you made money about a investment, even if the decision is not very sound, but you made money, then you would tend to, you would tend to make more decisions like that in the future. So in the long term, that's not gonna help you. Okay, so anyway, so these are like a positive side and negative side about the saying that's very popular in crypto that's called hodling. So obviously everybody's situation differ. You gotta ask yourself, what is your motivation? What is your justification for any decisions that you make? And everybody's different, right? But at least we should all be aware of the other side of the coin, because no framework or no decision is like complete certainty and bulletproof, even though the human mind is like really desperately tries to grab onto something of complete certainty, but that thing definitely does not exist. So so that's what I want to say about the two sides of this investment framework. So this is also related to something that is about like conviction in the space, how I think about the conviction, which is what I want to talk about next. But let's look at some questions first, okay? So basically, I had this article called Truth and Bullshit in Web3. The basic idea is that if you look at over the long term, what is the big deal about Web3 space? Now, to me, the big deal is we are building this internet of values, right, through tokenization. And tokenization is this amazing economic model that allows anything of value to have an expression as a tradable token. And you have the platforms that we call public blockchains, which is permissionless and open, and everybody can publish token and trade that with anything else on chain that is of value. And it's global, it's borderless. So this is like an amazing platform, amazing technology and economic model to create another layer of economic values in society, and to really change the economic distribution, has the potential to change economic distribution models that we have for the better in society. So over the long term, I see that as the trend of where we are going, which is internet of value via tokenization. And I'm extremely bullish about that. I think that is the long-term trend of this space, and it's gonna be it's gonna be a technology advancement to the greater good, and of course a lot of money are going to be made in the process. So that's one. But secondly, what is the bullshit? Is that if you look at most of Web3 projects, I think I already mentioned this in the previous episode, 95% of those really don't have a viable product behind. But because tokenization is such a powerful economic model, it creates this short-term illusion, because it gives you a bunch of short-term opportunistic users, quote unquote. It gives the short-term illusion that the product has traction. But actually, if you look past the tokenization aspect, the whole thing just fall apart. That's the reality for a lot of Web3 products these days. So and people take advantage of that. Sometimes it's a opportunistic venture. Sometimes people seriously believe that the tokenization model is going to carry them through to the promised land of a sustainable product, but most likely it doesn't. So when the wind blows the other direction, when the market sentiment changes, okay? So that is the basic gist of my point in that article. So I will link the article in the description so you can take a look, okay? So, but let's look at some questions about this article. And first one from John R. And he says, Tasha, I think you are bullish on layer ones with serious teams and real tech, such as Near Protocol, but I'm not 100% sure. Keen to know. Okay, so he's basically asking what's my opinion on layer ones. So I think I've talked about this multiple times. I think the layer ones is one of the best reward to risk ratio. If you're going to invest in crypto, you look at all the tokens, different types of subsectors and projects that you can invest. Layer one tokens, provided that that's a chain that has traction, okay, and has a growing user base, that is one of the best reward to risk ratio, because a lot of the value accrual on chain, no matter what type of projects that are built on chain, a lot of value accrual is actually accruing to the underlying layer 1 or layer 2 protocol, and also it's a bigger moat, and it's a bigger network effect, right? If they can actually build that ecosystem. So that has always been my view, then that hasn't changed. However, that still, you have to put that into the context of there's a time and place for any investment, right? So right now the macro sentiment is very severe, unfriendly to risk assets. So the market has gone down a lot. You can argue whether there is bottom is already in yet. I don't think it's in, but even if you believe it's in, that is a different thing from things we're actually looking up, right? You can be bottoming for months or even years. you can look at after the dot-com bust, how long have we stayed in a relatively bottom space, right? So you can be bottoming for a long time without the asset class doing anything. So if you tie your capital in that, even if you caught the bottom, that is a opportunity cost, right? So there's a time and place for any investment in any asset class. So that's one. And number two, this is more related to the conviction thing that I mentioned a few minutes ago. So a lot of people, when they especially those maxis about either Bitcoin or Ethereum or something else, their argument is, look, this thing has had 10 years of track record or 5 years of track record, and it's always been going up more than down. Okay, downward is always a correction, a revision, and then the upside is always way bigger. Okay, and that is the argument that people use for why you should hold on to that asset. But here's the thing. Bitcoin, it came out in 2008 or whatnot. That's only like 15 years. All right, Ethereum came out later, so it was like less than 10 years of history, and the other layer 1, layer 2 is even shorter, right? 10-15 years, it may feel like a long time in a human's life, but it's a short time span in any kind of technology evolution. You can argue that time has sped up, but still 10-15 years is not a long time to prove the long-term staying power of any asset. That's what I'm saying. Okay, so again, if you have an emotional reaction to that statement, I encourage you to look into that. What is causing that? Right? So what I'm trying to say is, you look at all the blockchain technology today, Bitcoin, Ethereum, Solana, Near, Avalanche, all of them, they are shit. And it's like a terrible scaling ability, terrible user experience. And this is not the technology as it is right now is definitely not going to hold the mantle or take on the responsibility of the global layer of internet of values infrastructure. It's right now we don't have the entire blockchain space. We do not have the capacity to actually carry the infrastructure load globally if we have a mass adopted internet of value layer globally, or if we are to have that tokenization internet value vision to come true today. We don't have an infrastructure for that. Okay, so all of the infrastructure we have today is kind of a proof of concept. Seriously. So if you look at take one step back, you look at things from a ultra long-term point of view. I do not know. I cannot be 100% sure whether, if 30, 50 years from now, the internet of value will have the same set of infrastructure as we have now. I'm not sure that would even be an extension of the infrastructure setup that we have today. So I think, to put it more bluntly, the Bitcoin and Ethereum or Solana, whatever darling of the day, blockchain today, whether they will be the predominant, decentralized computing infrastructure or even internet of value infrastructure 20, 30, 50 years down the road, I don't know. I think the likelihood is actually not low that they will not be, because just because the current track record, if you've seen like the tech development over the past 10, 15 years, so far we have not come up with anything decent that can be scaled globally to carry out the vision of Web3. We don't have it. Now you may argue, oh, there are all these experiments going on. There's zero knowledge. There's layer 2 rollups. There are these app chains, and there's like data availability layers and so on and so forth. Yeah, there are a lot of experiments going on. They're all very exciting. Something very exciting and sticky may come out of it, but is that a certainty? No. And let's just all keep in mind, we are investing in a very experimental technology space. Okay, it's experimental. We are very far from having any kind of mature technology in the blockchain space, in the Web3 space. Okay, so if you ask me, how bullish am I on the Web3? Long term, I'm very bullish about Internet of Values. How bullish am I about like a layer ones? No matter which layer one, okay, from Bitcoin to Solana, Avalanche, so on and so forth. About a lot of these layer ones that got traction, which some of them I mentioned in previous episodes. I would say if I'm to invest in crypto today or in the medium term, and they continue to have traction, innovations continue to happen, I am optimistic about these projects, and I think they are good reward to risk compared to other crypto projects that we've seen today. Okay, but are these going to be the technology of tomorrow? I don't know. May well be not. and I think you gotta hold that perspective in the back of your mind. All right, when we invest in these things. So this is probably this is how I look at conviction. Okay, so there are different layers of conviction and about different things. They may not all go the same direction, or they may not be the conviction all on the same time frame. So there are a lot of I think there are a lot of nuances in that, and a good skill I think we can all practice is to have seemingly contradictory views. You can hold the seemingly contradictory views over different layers and different time frames in your mind, and see the merits in all of them when you are making any kind of investment decisions. So I guess that's like one more argument against hodling, if if you will. So so the bottom line is, I don't think there is a foolproof, guaranteed thing in the crypto space. You are investing in a very exciting space of experimental technology. So that let's better keep that in mind. Okay. This is not. I don't think this is something that you can just put some money in and just like forget about it, if that money is of considerable value to you, unless it's like unless it's something that you totally don't care if that amount is so small, right? If that amount is actually meaningful, you actually want to keep track of the sector. You will want to know what's going on in the sector, how it's developing, because things can move very fast, and things can move in different directions. And also keep in mind that the past 10-15 years since crypto started in 2008 2010, that was the beginning of a like a bull trend in risk assets of advanced economies in general, right? So that was the macro environment that we've been in. So I don't think, if you look at if you step away and look at the long-term picture, that is like one cycle, the 10-15 years. But for the crypto investor, for the crypto people, that's like forever. Like, okay, this asset class is always going up. That's not true. Okay. So and now you see, like the macro environment changed, and some of the previous beliefs that was held by some people as definitely true. For example, Bitcoin and Ethereum, they can drop a lot, but it will never drop below the previous highs. That myth has already been broken, right? So and also some people will say, all right, if you look at the logarithm price trend, and the thing never drops below the 2 standard deviation. But again, these are like, you have to look at like what kind of context or the macro environment these historical data is being placed in, and whether that environment is still present today, right? So that's like a historical data. It gives you it informs your decision in terms of possibility, probability, but still there is a limitation to that, right? So none of these are a excuse to not to have risk management, or to not to watch your basket. Okay, so that's that. Next question from Daniel K. Tell us what you see as long-term truth. What is the real game in town to be considered as worthy long-term intrinsic value-based projects? Oh my God, this is like this played right into what we just talked about, right? So I find this concept really interesting, which is called intrinsic value. Because what exactly is intrinsic value? It's not to be too philosophical, but I don't think there is such a thing. Value is always in the eyes of beholder, and in order for your investment value to realize, for a gain to realize, you always need a lot of people to have the opinion that the thing that you are holding have value, and have a lot of value, and which is also something that they also want to hold. It's always in the context of people's opinion, whether those opinions pan out in the long term to be right or wrong. But the thing that has a positive price in the market has a positive price because because of people's opinion. So I just don't think this concept of intrinsic value is all that useful when considering your investment. So is it really, when price goes up, is that delusion of the crowd or is it intrinsic value? You you can argue that market is never neutral, so there's always some kind of delusion going on in one point or another. There is never a neutral point where the price is reflecting some kind of quote unquote intrinsic value very, very objectively. Okay, and also keep in mind financial market is like forward looking, right? So it's the kind of projects that goes up in value / price, okay, are whatever projects that captures the public imagination about the future, right? So those are the things that will go up. Does that mean they necessarily have more intrinsic value compared to those that don't see price go up? That's not necessarily true. There are plenty of mundane businesses that operate smoothly and steadily that gives a steady income, but the price do not go up. Good example: Tesla versus I don't know, Ford, Toyota. It does. This goes into the weeds of I don't want to argue with the bulls and bears on either side of Tesla, how much intrinsic value there is, but my point is financial market is forward looking. It's chasing growth, it's chasing the prospect, the expectation of growth, whether that expectation is real, is true or not. But it's really market reflects opinion, that's all. Reflects the predominant opinion. So that's why I don't tend to think about these things in terms of intrinsic value. I don't think that's all that helpful, but I understand the desire for the mind to want to find that fixed point, that's that point of certainty. That's all. That's what we all want to do, because we live in an uncertain world. We don't have foresight, and life is intrinsically uncertain. So all of us try to grab onto some point of certainty, and that reflects in a lot of the investment doctrines. But if you think there is something that is long-term intrinsic value based, I don't think that's going to be a helpful framework to think about things. Okay. Especially in terms of when it comes to managing risk. Okay, because that definitely tend to lure people into being complacent, especially about these high volatility assets. And again, we are in the space. The crypto is a space of experimental tech with liquidity. All right, so that is that. And the next question from Morning Shin: what exactly is the point of Web3 if it's not decentralized / censorship resistant? So this is, I think, referring to what I mentioned in my article. It's like there is this mentality of, okay, more decentralized the better, more censorship resistant the better. So projects go out of their ways to try to prove they're more decentralized. Okay, so there may be, like, if you're a DeFi product, there may be like a legal argument for why you want to be more decentralized instead of less, right? But in terms of product utility point of view, my view is there is only a small selection of products that actually for which decentralization or censorship resistance is actually a key value proposition. It may be, for a lot of product, it may be a nice to have property or feature, but it's definitely not a key feature or value proposition. for the majority of products and services in the world. So I think that the typical Web3 projects that you see in this day and age that tries to kind of create this narrative, oh we are decentralized, that's why we are better. That is kind of a misdirected thinking. Okay, so but I want to address this question actually. What's the point of Web3 if not decentralized? Now, to me, the point of Web3 is not about decentralization. It's about the Internet of Values. It's about tokenization as an economic model that allows more layers of value to be expressed in a concrete form that allows those to be tradable against one another. In a unified format, an example is ERC20 or tokens. It's a uniform format. It's a global platform that allows value exchanges to happen. That is amazing. To me, that is the fundamental breakthrough, and that is the promise of Web3 / Internet of Values. Okay, but if you look at this, if that is the value proposition, does it need decentralization or censorship resistance to exist? No. Okay, again, like I know a lot of Bitcoin maxis or Ethereum maxis would disagree with me, but but this is I want to present you this perspective, but you judge for yourself. Okay, most of the products, most of the values that can be embodied on chain can be tokenized, which to me, the tokenization aspect, again, is the biggest value proposition of Web3. And when you combine that with products and services that actually has a viability in real life, that is a very powerful business model for a lot of things. But do they all need to be censorship resistant or decentralized in terms of the computing network they run on or the database they run on? I don't think so. So there's a recent paper or report that just came out from a BIS, so Bank of International Settlement. Okay, so I encourage you to check it out. So I will link it in the description too. What the reason I bring it up is because that is like present you a different point of view, right? So BIS argues that because of the decentralized computing network, the EVM, the whatever blockchain network, the Bitcoin network, because the performance is so poor, and then the proof of stake, there are also different drawbacks of proof of stake and different drawbacks of proof of work. It's all a whole lot of effort going in to make things decentralized. Okay, but all of these efforts, all of these solutions all have huge disadvantages. And again, all the infrastructure we have till today in the blockchain space is pretty crappy. Okay, so they do have a point in that about these decentralized network not being able to fulfill the function of a Internet of Value globally at scale. So what they think it makes sense is the nation states of the world come up with their own centralized computing network or databases that take some of the merits of decentralized blockchains, namely openness and some of the permissionless features to allow other projects to be built on top, but keep this in the public domain, run by the nation state. It's like the CBDC blockchains, right? Or the CBDC network where private sector or whoever can build on. It could still be interoperable. It could still be borderless, but with some restrictions, whatever restrictions that nation states want to put on. I think what those are, right? But their argument is that is a much more performant and useful system for a Internet of Values to be built on. I'm not saying they're right. Okay, of course it's BIS of course, they look at things from the government's point of view. I'm not saying I agree. Actually, I don't. Because I just don't think government will do a good job in terms of inventing new tech, right? Or maintaining new tech, or a global network of Intrinsic Value that can be, for everything else to be built on top. I don't think the government will do a good job in that. I think the innovation fundamentally going to come from the private sector. However, a lot of critiques that they give about the current status of blockchain infrastructure is, I think, very valid. Okay, given a lot of the cost and the hoops that we jump through in order to achieve some decent level of decentralization, and at the end of the day, for what? Okay, so that gives you a different perspective, not like the right perspective, but again, this is something. It's always good to keep in mind different sides of things. Okay, so I encourage you to check out that side of the argument. Anyway, that's all for the questions. I will talk to you next time.